Joining me around the table here in New York City is Colin Robertson. He's head of fixed income at Northern Trust Asset Management.
Well, I think certainly we have an issue with the fact that inflation is staying so low, and it puts the Fed in a tough position. They can portray that they would like to raise rates, and that's the strategy that they would like to employ. But as investors are taking charge here, and as we know from some of the information with respect to Fed funds futures expectations, the odds are lessening and lessening as each day goes by that they could attempt another move this year.
Well, we came into 2017 and the central bias of the market was to be aggressively short treasuries. We were going to get this reflation trade, and that's how it was going to play out. And then ultimately everyone got squeezed, and it was painful. Are we on the opposite side of that story? Have we gone far enough to do what Andrew's talking about?
I think we have gone far enough. Clearly, there was a squeeze. There's no doubt about that, and the expectations were that rates were going to go higher no matter what, and they certainly didn't do that. I think one of the issues that I have that causes me concern, though, is the lack of true wage inflation. And so even though we're at full, or what would be deemed full through employment, yet we just can't get any wage inflation to stick, that gives me pause when thinking about if this could be a trade that should take place immediately.
Colin, when you think about the shape of the yield curve and where market positioning is, the market aggressively short the front end, long the longer end of the yield curve as well. But when the balance sheet policy starts to take hold, do you have to rethink that flattener that a lot of people have got on? I
think you do have to rethink it. It would be my expectation that even when the securities start to be brought off the balance sheet, that we could see some slight steepening from where we are. I think it goes back to the point you made just recently about the trade and the way it was looked at the start of this year and how a lot of investors got it wrong. I know from watching the show and watching through the markets that I think if you asked a lot of investors where would the next move be for 10-year treasuries, they'd say 2%, not 3%. Yeah. I think that that's the flip side of everybody else that came into the year and how they were positioned. And I think the danger and the risk to me would be that the movement goes to 3. Still with us to discuss risk and the prospect of complacency, Colin Robertson from Northern Asset Trust Management. There's a growing trend in credit, the lower quality names, boosting offerings, and extending duration as well. How are you thinking about that theme at the moment? With respect to the credit spreads and where they are, sure, we're at pretty tight levels in both investment grade and high yield, but I think that they can go a little bit tighter from here. And part of the reason for that is, I think, to what Marilyn pointed out and also Andrew, is the danger there, in my opinion, is more duration than the absolute credit. That being said, where do you pick spots where you might want to invest in the fixed income market if you have to, with yield-starved investors? And I would pick the high yield space. Colin, something I do want to talk about is high yield. You've talked about maybe carrying on being long, but if you just look at where Europe is trading right now, European high yield, if you look at the Bloomberg Barclays European High Yield Index, it's the tightest in 10 years. Yes. I mean, how much tighter can that index get if the ECB is going to pull back? I think it can still get a little bit tighter. I mean, we might be talking near the tail end of a handful of basis points, 25 basis points. But I do think it could get a little bit tighter from here. But I think the key thing to remember here is that it could be possible that we're near the end of a trade, but it could still have some duration left to it. I think when you pointed out the words that Howard said about the warning about Netflix, part of what was in his note was his admission of oftentimes you can be very early to the right call. And so I still feel that way really about high yield, is that, it could be petering out, but there's still a long process left. Well, I guess Colin Howard's point is it's better to leave too early than hanging around until you're too late. And I would ask, is the risk you're assuming really worth it if the upside is 25 basis points? It's worth it if it's going to last a while, because your alternatives could be ones that you would not want to be invested in. Shorter duration, less yield. As Marilyn pointed out earlier, I mean, we certainly are in an environment where there are yield-hungry and bond-hungry investors across the world. So sure, at some point there could be the judgment day. I just don't think it's right around the corner.